We're going to start off this morning by talking a little bit about the role of large institutions and their interaction with the economy, particularly during the course of the last 24 months, the pandemic, the aftermath of the pandemic, and the shock that that provided to the system and to the economy. And I guess beyond the aftermath, we have a lot of other things that have been going on, geopolitical events that continue to challenge us. And we want to explore the role of the institutions during that time, their interaction with the economy, the challenges that they faced, their performance during that period of time. We think that there are lessons that will be taken from these events. They may spur policy action, but the purpose of this panel is to discuss all of those dynamics and to try to give us a little bit of insight of what we've been through, how the system has performed, and what types of things that we're going to take away and what types of policies that we may pursue. We have an amazing set of individuals here, former senior government officials, private sector, and academic specialists who all of you recognize. I'm going to introduce each of them, and I appreciate all of you being here today for this session. To my left, Donald Kohn holds the Robert V. Roosa Chair in International Economics and is a senior fellow in the Economic Studies program at the Brookings Institution. Don, of course, is a 40-year veteran of the Federal Reserve, serving as a member and then vice chair of the Board of Governors from 2002 to 2010. He also served as an external member of the Financial Policy Committee of the Bank of England from 2011 to 2021. Don is an expert on monetary policy, financial regulation, macroeconomics, and he's written extensively on these issues. Jelena McWilliams is a partner at Cravath, Swaine, and Moore, joining the firm just very recently, and most recently served as the 21st chairman of the FDIC from June 2018 to this past February. Previously, Ms. McWilliams was the chief legal officer and corporate secretary for Fifth Third Bank, and also served as the deputy staff director and chief counsel of the U.S. Senate Banking Committee. Nathan Sheets is the global chief economist at Citi and leads the international bank's surveillance and forecasting of the global economy. He was previously chief economist at PGIM Fixed Income, Undersecretary of the Treasury for International Affairs, and a senior staff member at the Federal Reserve Board. I have a set of questions that I have drummed up to keep things rolling here, but I'm going to first recognize each of our panelists to make a few opening comments, starting with Don, and then Jelena, and then Nathan.
Thank you, Kevin, and it's great to be here. It's wonderful. I actually live 6 blocks from here, and I've never been up in this building. I've been in Trader Joe's, but never up here. And the green roof is really interesting, and it's a great view. So thank you for the opportunity. To your point, Kevin, I think that the large banks played a very stabilizing role in when the COVID pandemic started up. They met huge loan demands, businesses taking down lines of credit, small businesses using the CARES Act facility that was set up to support small businesses. It was an astounding, it was a couple $1 trillion, I think $1.5 trillion, Sean's out there somewhere, he'll correct me, but about $1.5 trillion of extra loans in just a short period of time. The banks were able to meet that demand and then take the flood of deposits that were coming in. So large banks, the banking system generally, large banks in particular, were a very stabilizing force as COVID came down. And that's quite a contrast, really, with 2007, 2009, that period that I was Ben Bernanke's deputy at the vice chair at the Fed, when both the non-bank system and the bank system broke down. And there were runs on markets and on banks. This time there were runs on markets, but not on banks. And I think that's a tribute to how strong the banks became as a consequence of the actions that the banks and the regulators took post the global financial crisis, and the fact that the non-bank system broke down is where that's what should be next, and that is next, I think, on the global stability agenda. I think there are three caveats here, three howevers. So one however, but is the buildup of capital and liquidity at the large banks was driven very important by regulation, I think, and by a regulation that had financial stability in mind. So I think if the private shareholders of the banks were driving the recapitalization, reliquification of the banks, so to a certain extent, if the regulators focused on each individual bank, had driven it, the recapitalization would have gone a little bit further. What I think really set the system up for absorbing this shock was the extra, what we would call macroprudential, the extra systemic capital liquidity requirements were put on, recognizing that these large banks in particular were so important to the financial system. So the regulation was really important, and macroprudential regulation is really important. I think the second, however, is that the banks were able to do this importantly because of all the support that came from the fiscal and monetary authorities. So CARES Act and then follow-ups later supplied households and businesses with credit and with supported income so that they could meet their obligations. And of course, the Fed took a lot of actions to smooth through the system, make the system more resilient. They supplied liquidity, they provided support for corporate and municipal bond markets so that businesses wouldn't be putting even more pressure on the large banks. They opened the discount window much wider for the banks. And there was some regulatory easing that I think Jelena will talk about. And the third caveat here, I think, is that it did raise some issues that I hope we get a chance to pursue here that are still outstanding. The Treasury securities market did not perform well. So you have a situation with a flight to liquidity and quality, and you have the market that's the foundational market really for the global financial system freezing up with prices going the wrong direction. So the demand for safety, and yet prices of Treasury bonds went down because of all the dumping of bonds, the dash for cash. Everybody wanted to be very, very liquid. And the dealer community wasn't equipped to absorb that liquidity and smooth that. And I think partly it was some regulatory things that maybe we can discuss later that constrain the dealer community. But I think fixing the Treasury market is very much unfinished business. Second point I would make is that the capital requirements that were put on have buffers in them. That there's a minimum and a bunch of buffers above that. And the theory is that as stress hits the system, banks dip into their buffers but stay above their minimums. They didn't. There's a great reluctance to dip into buffers, and buffer usability is a very both liquidity and capital buffer usability is a very, very important topic to explore, and I have an idea or two on that. Then the third thing I think that is one of the sources of the dash for cash for the hedge funds, who are very highly levered, and through the prime brokering system often. And I think the margining process for the in the central clearers needs to be less pro-cyclical, but I think it's also perhaps the case that the prime brokerage system needs to be looked at from a systemic perspective, and that's also, I think, to be explored.
Excellent. Thank you.
Well, I think this panel is done. You said everything you was to say.
Sorry.
And the last time I said this close to you, it was during the last financial crisis. And I briefed you at the Federal Reserve as a staffer.
Right,
So
right.
it's great to be here with you again and with you, Nate, as well. So I will just, in agreement with just about all of that, but I will add that back in March of 2020, I had an opportunity to be in the regulator seat, to be in the chair of the FDIC chairman. And as we saw the economic shutdowns across the country, it became clear that this is unlike any other crisis that the FDIC is going to have to deal with or has dealt with in the past, meaning we're used to bank not being liquid, fraud happening at banks. We can resolve those banks. What do we do when there's like this pandemic, once in 100 years pandemic, and everything shuts down, and all of a sudden, lending is restrained, the wage workers don't have jobs, and can't pay their loans, for anything from credit cards to student loans to household loans, et cetera, et cetera. And so we were faced with dire choices back then at the time, and I would say that there are like two stages of how we should be looking at the large banks' actions during that time. And I completely agree, they were the source of stability. And I think there's the first wave, which we're talking from like March of 2020 when the closures happened, and then before the CARES Act passed, because there was a lot of activity in that space that banks did prior to all of the government stimuli and the actual cash injection into the economy. And then there's the kind of a post-CARES Act implementation and what was done then. And again, you learn as a regulator, the road to hell is paved with good intentions. We give all this cash to people. People put all the cash in the banks. The deposits go through the roof because banks are seen as a source of stability, and now their leverage ratios are off. And so you start looking into kind of that wasn't the intent. We just wanted to help, and so it became one of those. I call it the whack-a-mole few months where you just waited to see what will come up, or if you heard an inclination of something will come up, and you went to that hole and you whacked the mole because you just couldn't allow what we had in 2008, 9, and 10 to happen. And everything that looked like it would cause a systemic crisis was looked upon as we cannot allow this to happen. So kind of preemptively, we did a number of things, and we can talk in more detail later about what they are, but providing some of the regulatory relief to banks so that they can actually stay in the business of lending and providing capital and liquidity to their customers. We can get into the buffers and all of that later, but I will save something for Nate.
Well, thank you. And I think my colleagues here on the panel have covered the ground exceptionally well. Let me just make a couple of additional comments. I want to very much echo this term that I think they both used, and that is source of stability, that the large banks and the banking system more broadly through the pandemic was a source of stability to the system. And as Don indicated, that is really a dramatic difference and evolution relative to what we saw during the time of the global financial crisis. And in this regard, I think we'd maybe even amp up the rhetoric just one more notch, that at times the banking system was actually relied on to be part of the solution to the challenge, not only providing stability, but proactively helping support the economy through the pandemic. And particularly there, I have in mind the role of the banks in the administration of the PPP program that was critical in helping to stabilize the economy, and particularly some of the small firms. Now, extrapolating that thought in the current episode, when I think about recession risks and the potential severity of recession in the United States, if one were to occur, I'd put on the positive side of the ledger that the banking system continues to be in strong position, well capitalized. And consistent with that, even over the last few months, as concerns about the economy and raging inflation have escalated, we've seen the banks increase their credit intermediation. And for what it's worth, on Friday, the Federal Reserve released a survey of 80 financial officers at large banks in the United States, and 60% of those roughly indicated that through the rest of the year they intended to continue to increase their loans. So it seems that this kind of source of stability theme that we've talked about was true early in the pandemic, and if anything, maybe we're continuing to see it in the current situation. Now, a second point that again is echoing some of the other points were made, but as someone who spends a lot of time working in the markets and speaking with market participants, I think there are ongoing concerns about the robustness of market making. And I think the reality is that for a variety of reasons, some regulatory and some the realities of business, the banks are not devoting the same balance sheet to market making as they were before the global financial crisis. Now, my sense is that during normal times when the markets are operating within kind of standard deviation bands of normal, that's fine. And the markets have been able to absorb those kinds of shocks. But we have seen some severe episodes of illiquidity. And the March 2020 episode at the beginning of the pandemic was extraordinarily severe. It was in the Treasury market, and it was just escalated throughout the financial markets. At the time, I was working for a large asset manager that was particularly focused on fixed income securities. It was a really difficult, painful time to be able to trade, that the markets were doing everything they could to protect and husband liquidity. And that really strikes me as an area where there's more work to be done and more thinking that would be necessary. And for what it's worth, it was somewhat less severe, but I would say that the repo tensions we saw in the spring of 2019 also kind of highlighted some of these risks. So I see that as very much an open issue. And then let me conclude my thoughts here with just a final question. And I ask this from a very kind of technocratic perspective. And I think that we are still struggling technocratically with the question of how much capital is enough. And how do we evaluate at the end of the day, how much capital banks need? And then the corollary to that is, how do we think about balancing banks' roles in supporting the direct provision of credit versus their roles supporting financial markets, and if you will, indirectly supporting the credit intermediation versus stability, which they have provided, as I've argued in several of these episodes. My instinct here is where we are at the moment is a lot closer to the right place than we were before the global financial crisis. But I still think that there's more hard work to be done, more intellectual work to be done to really answer that question convincingly.
Yeah, why don't we continue with that theme? And, Don, I know you've done a lot of thinking about this.
So on the Financial Policy Committee at the Bank of England, we dealt with this issue. And we were required by the law passed by Parliament to do a cost-benefit analysis justifying where we came out on bank capital. I would say it was rough. We used some past studies. The staff at the bank modified those studies to try and but it's possible to come up with some rough estimates, and then you have to make allowance for, we have a new resolution regime and all kinds of things in there. But we did, and we came out, I think, comparable with the US. I'm not, right now, I'm hesitating because right now, UK banks have considerably more capital than US banks. So the stress-tested banks in the UK are at 14.5. And the stress-tested banks in the U.S., and that's more than the 8 you're talking about, are at 12.5. I'm looking at Sean. I don't know where your 8 are, but so I was, maybe when I saw this in the booklet that you guys did on the COVID response, I was a little surprised. The U.S. banks have less capital than UK or EU banks, and that was a little surprising. But I think it's possible to at least make estimates. I think the problem in the U.S., sitting here in a law office, is that cost benefit is weaponized by the people being subject to the regulation, and it's tied up in courts whenever a cost benefit is done. And so there's much more reluctance to do that in the U.S. than there is in the U.S. But I think it's possible, at least to take a stab, put something out there in a transparent way and let people decide. The costs of the systemic crisis are huge. And you can make estimates, and people have tried to make estimates, and then you try to get the bank capital to meet that. But hasn't really been tried in the U.S.
So we had this, framework that was built up over time post-crisis, and it did, as I think we all agree, provide stability for the system, and it enabled the institutions to perform at a time of stress and volatility. And it was the first true test, I would say, that we've had. But there was also, in addition to macroeconomic stabilization efforts, which fortunately our government is in a position to provide to the country when it needs it, there was also actions that were taken that, Jelena, you may reference to introduce flexibility so that the institutions could perform to the extent that they needed to. Talk about the regulatory flexibility that you and others amongst your colleagues in the College of Regulators here provided. What did that look like? Why was it necessary? What does it reveal about the framework that we have right now?
Yeah, I think it's really interesting, and I think especially if I was a lowly staff attorney at the Fed during the 2008, 9, 10 crisis. If you see that crisis from that lens inside the Fed, and the Fed wanting to do as much as it can, and looking at the tools and options, and do we have the regulatory powers? Do we need more power from Congress, et cetera? And you compare it to this crisis, I think you had a few veterans from that crisis having learned those lessons say basically, no, we're just, we're going to do stuff, and if we get reprimanded later, we're just going to get reprimanded later. And you're talking about a number of people who actually, by virtue of our appointments, were, believers in limited government and all of that. So to expand the roles of the regulatory agencies and to expand how much we can do wasn't necessarily organic or innate to our thinking. Having said that, it was important that we act in a way that would enable banks to do what they needed to do. So during the first, I would say 10, 20 days, 2 weeks, the first 2 weeks when the pandemic, and I say when the pandemic started, I'm using the date when the official, World Health Organization declared the pandemic, and then the White House a week later basically declared the national emergency in the United States. So from that time when we realized, okay, the businesses are shutting down, this is going to be really bad, it was paramount for me to, at that point in time, reach out to our biggest bank CEO. So I called the biggest 10 banks at the FDIC. We don't have as big banks as you have over at the Fed, but they're sizable in their marketplaces. And basically the question was, what do you need? What are you doing and what do you need? Because we need you to make loans. We need you to make sure that people stay in their homes. We cannot have any foreclosures that are not warranted. If the loans were performing before the pandemic, they should be looked upon as performing during the pandemic. And inevitably, I would say 8 out of 10 CEOs basically told me they're already modifying loans. They're working with their customers. They're running into problems that are the accounting standards. So under GAAP, any loan that's being modified, runs into the treatment and classification as impaired or troubled debt restructuring, TDRs. And some of these banks still have loans on the books from 2008, 9, 10 that they modified that are still performing. And yet they're in this TDR category. The marketplace looks poorly upon the TDRs. The examiners don't look favorably upon TDRs. The banks don't want to have them on their books. So the question was how, they want to modify loans by virtue of the classification of the accounting standards. This is going to be a problem. What do we do? And, it took literally, I think, 2 calls to FASB, the Financial Accounting Standards Board, to say, can you do something about this? Mind you, this is back March. We're not talking about government action or congressional action at all whatsoever. We didn't know that there would be a bill, what kind of a bill. We didn't know that the pandemic would go through the summer, let alone 2.5 years later. And so FASB agreed, and one of the earliest documents that we issued was, I think, 5 pages long. It talks about, instructs banks, work with your regulators. Work with your customers. There were 5 regulatory agencies on that issuance. But there's one sentence that I basically called up all of the 10 bank CEOs, and I said, if you pay attention to nothing else, pay attention to this one sentence, and that was that FASB concurs that loans modified for the purposes of the pandemic that were performing before the pandemic and are now being modified are basically not going to be considered TDRs for the duration of the suspension or the national emergency. I think that's how we phrased it. And so from there, we went into a number of other actions. Speaking of buffers, we told banks, dip in your buffers. And first, we got a few incredulous calls back from the CEOs and chief risk officers and the chief legal officers. Do you really mean that? Yes, we do. Go ahead and dip in your buffers. Buffers are there to be dipped into. And they said, we've never heard a regulator say that. We always took that, here's the, X percentage capital level, here's the buffer. That's really the level. So that X is like, just kind of to make us feel better, but we really need to have the X plus. And so when we asked them to dip into the buffers, and we can talk about the viability of the buffers and whether they work the way they were supposed to, but they wouldn't. Partly because they were concerned what the regulators would really think 6 months down the road, and then partly because the market expectations were that whoever dips into the buffers first, those capital levels go down. What happens now? They're going to be looked upon as a weak bank. I quite often think about TARP and TALF and the bank executives saying, I don't need the money. I don't need the money either. But you want me to take the money, to make sure that we all look alike. Okay, so these banks, we needed somebody to start dipping into the buffers, and actually we encouraged them to dip into the buffers. So, we did before, I think this was before even the CARES Act, we did the CECL modification for capital standards to allow banks. So, when we talk about regulatory actions, government actions, we all think about, that big bag of cash, however many $1 trillion it ended up being in the end. But there were all these incremental actions before we knew there would be that bag of cash that in the end allowed banks to continue to bank their customers, allowed customers to stay in their homes, and allowed us not to have foreclosures and widespread delinquencies on credit card payments, et cetera, et cetera. So I can go on, but there's a speech you can read that's a little bit old now, and I know Vice Chairman Quarles as well gave a 25-page speech, which is much longer than mine. So, well, you're welcome to revisit those.
Well, and
still shorter than Tarulos, apparently. So his was 26.
by about a page, I think.
by a whole page.
Yeah, by a whole page. So, what does that say? What does that mean we should be thinking about if you have to use these, if you have to take these actions? Should we go back and look at them and try to make some judgments about, are there things that we have in place that worked correctly at that time, didn't work correctly at that time, and required us to make some changes on the fly and provide that flexibility? I mean, what now that you're out of the ivory tower of the FDIC, what does that tell you?
It wasn't ivory. Okay. I would say that it's absolutely paramount to retain flexibility in the system. And most often, as you know, we talk about Dodd-Frank, we talk about rules and regulations and laws that Congress makes and regulators implement rules and regulations. Most of them are done for the prior crisis. So, we'll try to fix X. X happened 10 years ago. We're now making rules to fix X, right? Well, when Y happens, it doesn't look like X. X is maybe helpful, maybe not, but the rules we have on the books now are for X. And so I think it's really, I would say 2 things. One is, no matter what we do, retaining some regulatory flexibility so that when things happen and you never thought they could happen, like a pandemic, and countrywide economic shutdowns, that you can do some things. That there is some delta in the flexibility that gives you to act, and I think that's important. Second thing I think is important. Don talked about how politicized cost-benefit analysis is. Every action a regulator takes is a political action, and every action we take is looked at through a very political lens. And people read things into that action that you're like, wow, I never even thought that interpretation was possible. You just opened up a whole new chapter, like I didn't know that book existed. But people look at it through that lens, and they always look for, oh, you did it because of this and this thing. And in reality, I think that it's important to have regulators who basically, I don't want to say have a backbone, a lot of regulators have a backbone, but are willing to step up and say, no, listen, we're going to do this, hell or high water, we're going to do this. You can blame me later, but this is what's necessary at this point in time. Whether or not you agree with it politically, whether I'm from the left or right, this is what's good for the system. And I would like to think that that's exactly what we did back then. A lot of the actions we did weren't necessarily on the top list of Joseph Otting or Jay Clayton or Randy Quarles or Jay Powell at the time or myself, but it was like, okay, all right, let's go. And some of them are actually a repeat a little bit. We're talking about money market funds and other stuff like that were a repeat of 2008. And you're like, all right, let's go. Buckle up. We're in for a ride. And we're together.
I want to go back to market making, and we'll hopefully have time to go back to buffers as well. But Nathan, just want to kind of pinpoint this question about what the banks were able to do at that point. And from your standpoint, was the environment conducive or sufficiently conducive for the institutions, the banking sector and the large banks in particular, to perform this role, this massive amount of credit provisioning and supply, notwithstanding some of the things that required some exercise of regulatory flexibility? I mean, bigger picture, what's your judgment?
So my sense is that the banks were subjected to a massive, unexpected stress test at the onset of the pandemic as this shock hit, and they faced this huge demand for credit. And in terms of credit provision and their ability to support the economy up front, it seems like that it was adequate both in terms of preparation and in their response and in their willingness to provide that credit. And one of the things was going on in the economy at that point was that there was just a massive demand for liquidity as firms saw a potentially devastating shock and wanted to build up as much reserve and buffer on their balance sheets. And I'm talking about non-financial firms were trying to do this. And the first stage of that was this massive loan demand, drawing largely on lines of credit that were already existing, that the banks accommodated. The next stage of it, and during this stage, the bank's loan provision fell off, but there was massive provision of credit through financial markets and bond issuance. And again, a lot of that intermediation through the markets was underwritten and involved the large financial institutions in one way or another. So when I look at the support that the banks provided to the economy, in addition, I also talked a little bit about the PPP. There's another angle to which they were doing it. I would say that it seems like it was adequate. And it's really more this kind of the market making during the time of stress that causes me concern, where I think there's more work to do. But as a general statement, over the several year period, continuing to what we're seeing today, it seems broadly that the answer to that is banks are able to do their role, and I think that is encouraging.
So there is, I guess, what I'd call some regulatory uncertainty out there, especially with respect to the unfinished business in connection with market making, liquidity, the treasury markets. Are there? Go back to you again, Nathan. Are there other sources of uncertainty or challenges? You represent the largest international bank, certainly headquartered here in the United States. What is the what in your judgment are restrictions or challenges, or maybe it's just regulatory uncertainty that you think about going forward, that your institution thinks about going forward?
The macro environment is clearly front and center on this. If I were to focus on the regulatory kind of policy front, I would say it's the implications of quantitative tightening and that potential substantial reduction in reserves, and then ongoing interactions between that and the SLR. And one of the things that I've seen that's really been quite extraordinary and somewhat surprising to analysts going in is that over the last 6 months or so, as the Fed's balance sheet has stopped growing, is now starting to shrink a little bit, as we've seen a massive runoff in bank reserves. And the expectation was that the reverse repo facility would roll off first. Bank reserves 4 or 5 months ago had peaked at around $4 trillion. This is looking at the Fed's balance sheet, and now they're down below $3.25 trillion. And what's happening is that a lot of the large institutions are constrained by the leverage ratio. And they have been happy to allow these reserves to roll off. And to the extent that we believe that the leverage ratio should be a backstop rather than kind of the front and center constraining factor for the banks in their business operations, I think that does raise some legitimate questions thinking about the calibration of the SLR, at least during times when Treasury issuance is large and the Fed's balance sheet is large.
Don, let me kind of pivot to you, picking up on what Nathan just says. So we started a little bit earlier talking about this disruption, this dysfunction in the Treasury markets, and we've had a lot of analysis. The Group of 30 came out with another update of its working group on this topic and focused very specifically on the supplementary leverage ratio and realigning leverage capital with risk-based capital. Where do you think we are? What do you think we should be doing to? That's just one particular reform, but what are some of the other things that we need to be seriously focusing on in terms of making sure that we don't have dysfunction in the Treasury markets?
Yeah, so I think we need to work both on the demand and supply side of the demand for market liquidity. And on the demand side, which really isn't the banks, we're looking at the pro-cyclicality of margining. We're looking at first mover advantage in mutual funds. I mean, a huge supply of treasuries flooded into the markets because people were cashing in their corporate bond funds, that kind of thing. But on the supply side, I agree with Nathan and you that the supplementary leverage ratio, which was put into place when the Fed's balance sheet was small and expected, actually it was a little bit large, but expected to shrink. So having the large balance sheet by the Fed means a lot of reserves in the banking system, which pushes the banks up against the leverage ratio, and that's just not performing the role it should, as Nathan said, as a backstop. So the Fed, a year and a half ago, well, first of all, to Jelena's point, one of the big flexibility issues was the Fed exempting reserves and Treasury securities from the denominator of the SLR. Then they put them back on. They let that exemption lapse, and they said, we're going to fix this. And I think the press release said soon. So even in Fed time, a year and a half isn't soon. So I think it needs fixing. I don't know exactly how to fix it. I certainly would exempt reserves. There are issues with that because that means reserves and treasuries have different requirements. My suggestion that I made at a speech in Jackson Hole last summer was that put that exemption back on, at least for reserves, but put in risk-based capital a counter-cyclical capital buffer. So this gets, I'm transitioning to buffers here. So in the UK, we had a counter-cyclical capital buffer. It was 1% when the pandemic hit, we released that buffer. We said, use it. And we promised we won't put it back on for really 2 years. So because so you've got that. And the beauty of releasing a countercyclical capital buffer is that's that much more space before you hit some restrictions on dividends, share buybacks, et cetera. It gives the banks much. And a number of European countries, but others, had released countercyclical buffers. And I think the preliminary research on this suggests that that was successful, that it encouraged banks to use their capital, to dip into what had been part of the counter. So I think I would release some of the leverage ratio, add a little bit of countercyclical capital buffer within the risk-based thing, so so lowering leverage ratio doesn't really release capital, and make the bank capital less pro-cyclical and more counter-cyclical with a counter-cyclical buffer.
All right, so let's engage on that topic, because it's a big question, and as we all know, and as you three particularly know, we have these through the cycle capital requirements right now that are very high, particularly for the U.S. GSIBs. We have a GSIB surcharge that's bespoke to these institutions as well, which is twice the international standard for that particular part of the framework. And then we have common equity tier 1 capital was about double what we had pre-crisis. So we have, and we saw Randy Quarles talk about this in his departing speech, 1 page shorter than Dan Tarullo's, talking about how, for instance, we have a CCYB almost already, it's effectively on now. How do the other panelists think about buffers and the encouragement to use the buffers, but the experience not being the case, as well as other levers that we might consider in reaction to Don's thinking on this. Others.
Go ahead.
Oh, okay, I'll be short. I think that if we saw anything from the necessary adjustments we had to make to different ratio buffers, take this out, put that in, it is indicative of the fact that I dare say buffers didn't work as intended. So if the idea of a buffer as a definition is, buff into it, go into it, use the buffer, it's there to help absorb the shock. Whether the market expectations that were built in the pricing and everything else, or the regulatory, I would say either fear or apprehension from the banks, the buffers did not work as intended. And so it became like a little bit of a tug of war. What do we do now? We told you to dip into the buffers. You're not dipping into the buffers. And you want to dip into the buffers, but you're not dipping into the buffers. So I think there's like almost the way that we have structured the different levels of capital and liquidity, and with the buffers, I think that the de facto is that buffers are the capital. And so I think there needs to be like if we keep the buffers as they're now, there needs to be a destigmatizing of the buffers. They're really meant to be, you take a little bit, you go below the level, you go above the level, you stay above in the good time. If you need to dip in and there's a stress to the system, you dip in, right? And then that should be built into all of the Fed's stress testing and internal stress modeling, et cetera, et cetera. So I think from that perspective, I think more can be done about, and then just kind of a recalibration. Again, remember, we put all of this SLR, leverage ratio, we put all of these rules in place in response to the 2008, 9, 10 crisis. And we saw now that banks were liquid. There was a lot of capital in the system. The underwriting standards were strong. And yet we struggled with kind of the final formulation of how do we do this and how do we allow them to do what essentially, they should have been doing during that time.
Well, I take careful note of Don's cautious optimism on this, and I appreciate his view. I'm probably a little closer to Jelena on this with some deep concerns that I've really had for quite some time. And one of them, I think, is just the reality of markets. And these institutions have to face market realities on a day-to-day basis as the downturn proceeds. And during these periods of stress, market analysts, market participants look at capital positions, and a sign of strength is more capital versus less capital. I think that was certainly true during the GFC, but is true more broadly during times of downturn. And I think it makes it difficult from that perspective to release these buffers. The other point that I would make is maybe more institutional. And I recall I was inside the Fed during the global financial crisis, that senior policymakers, the Ben Bernanke's and Don Kohns of the world, were emphasizing the importance of being pragmatic and of macro-prudential considerations as they were interacting with the banks. We've got to be aware of what all of this means for the economy. But deep down inside of the institutions, the reports we were getting from the micro-prudential regulators and from the institutions that were being supervised is often the folks in the trenches are very conflicted about releasing capital during times of stress. So 2 issues from my perspective that should be addressed on these buffers. One is, thinking hard about how the markets are going to respond to that and what those realities are. And second is, how does the public sector coordinate its message in its supervisory efforts of these institutions?
Yes, I agree completely with Nathan. And I want to raise this also. The supervisors need to be educated. So you have to start with a high enough capital that you're comfortable as a supervisor or as somebody lending to the institution that as the capital goes down, it's still very, very well capitalized. And that's why I think when I was sitting on the Financial Policy Committee, I was thought, whatever the issue is, let's round up on capital. I'd rather have too much than too little, recognizing that there are some costs to too much, but that can often be countered in other ways. So I think the supervisors needs to start high enough, and then the stress tests. So key to any counter-cyclical capital regime are tough, credible stress tests that get harder the better is the economy. So you have capital requirements that rise in good economies and then fall in bad economies once the stress is released.
I can add one point, Kevin.
Of course.
I will say never underestimate, and I think both of you know this from your personal experience, never underestimate how difficult it is to do the right thing at a time of stress. Because politically, every lens is on you. And what makes sense for the system, like, for example, taking the treasuries, et cetera, from the SLR, all of a sudden it looks like it's a gift for banks somehow. And in reality, you're like, no, it is not. Treasury market can't function without this the way you need it to function. And right now, we need a functioning treasury market. So I would say that in a vacuum, in a perfectly benign system, when politics doesn't play a role, I would say kind of like the UK regulatory system, because even the regulators are less politicized there than they are here. But then they had all kinds of issues lately. That I would say that, building something, some defenses, some flexibility into whatever it is that we're talking about, buffers, supervisory expectations, market expectations beforehand, so that when the crisis happens and we actually have to say, okay, now we're going to do this, it doesn't look all of a sudden like it's a favor or it's a, anti-bank, pro-bank. It's actually for the functioning of the marketplace. And in the end, that's what helps the consumers stay in their homes.
Well, I'm going to have the last word on this, which is to say that as in finance and banking and as in life, it's important to do the right thing always. So I want to thank all of you and appreciate your very, very informed perspectives on these issues. And thank you for being here this morning.
Okay.